Hi, this is Calvin here. Welcome to Module 6 of Trade the Markets Like a Pro webinar education series. In this module, I will cover volatility strategy, a follow-up on Module 5 where I introduce indicators and as well as a build-up to the earlier Modules 1 and 3 where I cover the foundation of support and resistance and as well as market cycle. So before we start, let's take a look at the disclaimer slides first. All right. So if you could recall in my module 2 where I highlight to you all there are actually four main types of trade that we could actually execute in a typical four market cycle. So in this volatility breakout strategy, I'll be covering this particular support and resistance breaking. That means we got to identify a range configuration first and look to trade breakouts from lower and upper boundary of the range. All right. So first and foremost, there are five key steps to actually we need to actually understand in this volatility breakout strategy. Is number one, we need to identify the higher time frame trend. That means, i.e., if we are looking to trade in a shorter time frame, let's say the 1 hour chart for a short-term breakout strategy, we always need to look at a daily chart to actually understand what is the main trend because it's easier to actually trade the direction of the trend. Conversely, if we are looking to trade a swing trade, let's say for stocks on a daily time frame, the higher time frame trend will be the weekly chart. Then next, we will determine the potential strength of the trend via the relative strength index. So if you could recall, what are the main principles of RSI, which I covered in module 5. And third, we look out for a squeeze and contraction price action via Bollinger Bandwidth, which I covered in module 5 as well. Fourth step, pardon me, is to determine the support and resistance for that trigger point and the exit levels. And fifth, we got to ask ourselves, hey, is this trading setup worthwhile for us to take the risk? That means we got to understand how do we calculate the rewards and risk payoff ratio, taking into consideration of the placement of the stop loss. So in all these five steps, I will actually cover in a bullish volatility breakout strategy as well as a bearish breakout strategy in greater detail. So now let's start with the bullish volatility breakout strategy setup first. So let's say I'm looking to trade in a very short-term time frame on the Aussie dollar. That means I'm looking for a 1 to 3 days of trading setup on a hourly chart. So the first thing to decide whether to trade on a bullish or a bearish strategy breakout is I got to understand myself is that I got to look at the higher time frame chart of the Aussie dollar first. So immediately I will switch to the daily chart on the Aussie dollar. So the first thing to decide over here is, hey, is Aussie dollar trading in a uptrend, downtrend, or sideways? And one of the most easiest way to identify trend is by placing in the moving averages overlaid on the chart, which is the 20 and the 50-day. The 20-day 50 moving average will be in red, the 50-day will be in dark blue. So as we could see over here is that the price action, the latest price action of the Aussie dollar is been trading in a series of higher low, okay, holding above the 50-day moving averages, and the 20 is above the 50. So what we could see that this is in a uptrend. So being in the uptrend, we are actually look to trade breakouts on the shorter time frame from the bullish side of the picture rather than bearish. And next, this current uptrend, we got to see how strong in this uptrend is. We quite to determine the strength of this uptrend is by using the momentum indicator called RSI. So the first thing to look out for is the RSI trading above a corresponding support like we see over here? Yes, it does. And also, has it reached the overbought level? No. And it does not have any bearish divergence signal. Alright, so all in all, what we could see over here is that the strength of this ongoing uptrend as depicted on Aussie dollar in the daily time frame is still relatively positive and strong. Okay, so the next step is going down to the lower time frame is I look out for a squeeze period or a contraction period in price action. So how do I look out for contraction or squeeze period in price action is by opening up this indicator called Bollinger Bandwidth. So this Bollinger Bandwidth, I'll look out for a squeeze in the trading time frame, which is my 1 hour time frame. If you look at the recent price action of the Bollinger Bandwidth is actually declining. So which indicating to us that the upper and the lower Bollinger Band is actually getting closer and closer in terms of its width. So that if you could have a recall, take a look at my module 5 module 5 video where actually I explain in greater detail what is a Bollinger Band width. So a Bollinger Band width that is declining is, we call it a squeeze period. That means i.e. price action of this shorter time frame 1 hour Aussie dollar is actually contracting as the times goes by, which is actually due for a potential breakout. All right, so the next key step is to identify the or determine the trigger level, the entry level, the exit target, as well as the stop loss by plotting support and resistances on the 1 hour chart, which is the Aussie dollar. So we could see over here, this will be the intermediate resistance of this range configuration that the Aussie dollar has been involving with a very lower bandwidth. That means bandwidth is declining as depicted on my earlier chart. So this will be my trigger level at 0.7790. So I will look for a potential bullish breakout setup, any price level above 7790. Then thereafter, I will this will be the entry level that definitely is more than the trigger level. Then I will have two exit target, one for me to take partial profit as a resistant one, the previous or the latest swing high before the range configuration that is being formed, which is at 7806. Then what is the higher level? Still recall that in module 1 we could actually do ascending channel. So ascending channel is a dynamic price action. As price action continue to evolve within this dynamic ascending channel, the upper limit of this channel will be my resistance. So this will be my R2, which is at 7860. So the reason why I'm plotting this is I'm plotting beforehand. Later I'll share with you how do I calculate my expected reward versus the risk that I'm taking. Alright, so as we all know that all trading strategy, there's no 100% foolproof. What if this trading strategy doesn't goes in our favor? We got to know what level for us to get out. All right, so the next for levels for us to get out is we need to determine how to place the stop loss. Okay, so basically why do I draw support and resistance is because over here, if there's a bullish breakout above 7790, we want to have a clear breakout to all the way target the upper boundary of this ascending channel at 7870, which is the resistance 2. In order for us to maintain this bullish expectation, certain key support level must hold, which is this support level over here that I draw. So to have a proper breakout, any break of this support level, we could actually say that hey, this short-term uptrend has more or less been invalidated. All right, so but we cannot place the stop loss right exactly at this support level. Okay, as you know that price action of any tradable instrument, they'll be subject to whipsaw. If I place it exactly at this level, like previously hit this support level and price start to rebound, I will get stop out unnecessary. So I need to place certain level below this support to give it a bit of breathing space. So mathematically or statistically, how do I come out with a reasonable stop loss level to prevent potential whipsaw? Is I will use the average true range indicator as a gauge. So an average true range indicator is actually telling to us statistically what is the range of this instrument in a shorter time frame trading at this point in time, 1 hour, as the price approaches the breakout point. It's actually trading at 0.0011, which is 11 pips, we call it in FX. So with this 11 pips, right, this will be the average true range. So after I derive from this average true range, I'm able to know that hey, if price action travels below this average true range, it will be considered as excessive. So I will determine a factor based on my own experience. I'll do it 1.5. Some of you may do it more conservative at 2 times the ATR. So my stop loss will be based on this intermediate support level minus of the factor 1.5 times by the average true range of 11 pips, which give us at the support level at 77.31 minus of this 1.5 times by 0.011 pips equals to 77.15. So this will be my stop loss. That means, i.e., if price action didn't hit my stop loss level, I will be still in the trade, because this stop loss level, once it hit, it will determine that, hey, price action have already traveled by a relatively fair bit away from the support level, that I would not want to tolerate further potential losses. So with that, right, I could actually calculate whether this bullish breakout strategy is worthwhile to take the trade. All right, in terms of reward risk ratio payout. Okay, so this is what I mean by how do I calculate the reward risk ratio. Okay, so for risk management over here, the expected reward will be taking my end game, or my end desired result will be the R2, the resistance 2, at 78.70 minus off my entry level, which is above the trigger level, the breakout point at, let's say, at 77.91. So at 0.0079, 79 pips will be my expected reward. That on top of that, by having this expected reward, is it worthwhile to take the risk, which will be my entry level at 77.91 minus off my stop loss level, which I derived earlier by taking based on 1.5 of the ATR level, which has 11 pips, which is 77.91 minus 77.15, will give me a expected risk. That means amount that I will lose for one trade will be at 76 pips. So I get these two, reward and risk, I divide, I'll get 1.04. So anything that is above, slightly above 1, I will say that, since this is a short-term trade, I will say that it's a decent reward risk ratio. So a reward risk ratio that is not acceptable will be definitely less than 1. That means I'm taking on more risk than reward if I get stop loss. Alright, so now how about, let's take a look what happened next. So in the end, it actually managed to actually hit the R2 and it continued to actually drift up much further. Alright, on this bullish volatility breakout strategy setup on the Aussie dollar. So now let's move on to the reverse, which is the bearish volatility breakout strategy setup. So let's say now I'm trading on a shorter term time frame, looking for a bearish breakout on a hourly chart. That means looking for a 1 to 3 days of trading potential on the dollar CAD, the dollar Canadian dollar. So the first step is, even before I start to do my support and resistance and determine my trigger point, my stop loss level, the first thing to decide is, hey, what is the higher time frame trend of the dollar CAD? Because as we know that in trading, we are talking about probability. So is to actually have a higher probability of success is to trade with the higher time frame trend, and also to have a gauge whether this higher time frame trend at the moment in time, has this trend been losing strength, or has the strength of the trend is still being maintained. So the first step to look at it is that, hey, we know that to determine trend, we look at a series of higher, the low and the high. So we could see that the lower high is getting lower, the lows, the lower lows are getting lower. So we could see that at this moment in time, it's been trading, the lower high has been kept by a descending trend line resistance. So very obvious to us that this dollar CAD here on a higher time frame is trading in a downtrend. Then the next key step, we ask ourselves that, hey, is this downtrend losing strength? That means we need to determine the strength of this downtrend is by looking at the daily RSI index, which is a gauge on its momentum. Alright, so at this point in time, the RSI is still below its corresponding resistance, as drawn from this descending trend line, capping the previous lower high, okay, capping over here. And at this moment, it's not oversold yet, and definitely there's no bullish divergence signal. So we could say that in terms of probability, this strength is still relatively strong on the downside for the dollar CAD. Okay, so my first filter has already been done. The next filter is now I will go into the hourly chart to look out for that squeeze period. Okay, look out for Bollinger Band squeeze in the trading time frame, which is my 1 hour time frame. So as we could see that at this point in time, the Bollinger Bandwidth is also declining as well, indicating to us a squeeze position. That means we're talking about volatility is contracting on a lower time frame for dollar CAD. Then the next key step is to determine the trigger level the entry, the exit target, as well as the stop loss. All right, so right now the trigger level will be based on the support. Still recall, we are looking for a bearish volatility breakout strategy setup. So a break below this trigger level here, which is this is the so-called this minor or short, very short-term symmetrical triangle that the 1 hour dollar cat is involving right now. So this will be a trigger level. Any break below 26.13 will be my entry level. All right, so entry level less than the trigger level, and two support level, this will be my first support. So the reason why I'm having two support levels, same with the one I have for the bullish volatility breakout where I have two resistance level, is for us to have to take a bit of partial profit once hitting this first support and allowing the remaining position to actually ride to hit S2, which is the next swing low. So always the first potential level for us to actually take partial profit will always be the first support level that form prior to the short-term range configuration has taken shape. All right, at 25.75. The next one will be at 1.2470 on the dollar cat. All right, so with that in mind, right, the next key thing is I got to determine where is the stop loss. All right, so now stop loss level is based on the resistance, because for us, if we were to have a successful bearish breakout strategy, okay, well, I'll call it a bearish volatility breakout strategy, is we want price to actually transverse or go down to hit our S2 rather than going up and break above the resistance. All right, so this will be the intermediate resistance, which is at this level here. So definitely we cannot place exactly at this red line, which is the resistance of this minor symmetrical range that is involving. So by placing exactly at this red line, we are subjecting to whipsaw. So how do we know that if this whipsaw is getting too extreme? Where we got to get out is by looking at statistically the current ATR value, the average true range of the dollar cat on the 1 hour time frame, which is at 0.0017. So we call it in 17 pips. So with 17 pips, right, the resistance over here is at 1.2680. Same thing, plus by a factor, instead of minus is plus, because we allow a bit of tolerance on the top side before actually hitting that stop loss where we get out of our trade to say that, hey, price action has really moved against us. All right, so 1.5, a factor of 1.5 times by 17 pips plus by 2680 give us 1.2706. So this is the maximum amount I got to tolerate. That means, i.e., once the price hit above the red line, I can tolerate a bit at 1.2, let's say at 1.2690. I'm still in position, but once it hit 1.2706, I got to get out, because this is where I will say that, hey, my directional bet or my directional view is wrong on this bearish volatility breakout trading setup. So with that, I could actually calculate my reward risk ratio. Still recall that we want to have a trading setup that has a reward risk ratio of at least 1 or slightly more than 1. All right, so now over here, so the calculation will be slightly different from the bullish one. The bullish setup is, firstly, it will be because we're looking to have a bearish one. That means we are looking to have an initial long short position. That means we look to sell higher and buy back at a lower price, which is the S2. So my entry level will be a break of this support at 1.2612 minus of the S2, which will be my potential exit target level at 1.2470. So this gives us 0.0142, which is 142 pips. All right, and the expected risk will be my stop loss level minus of my entry, which is at 1.2706 minus of 1.2612, give us 0.0094. that will be 94 pips. Okay, we have, once you divided by the expected reward divided by the expected risk, which is 142 pips divided by 94 pips, this gives us a ratio of 1.51, which is more than 1. So definitely is a, I would say that is a good reward risk ratio trading setup over here. So let's take a look how it actually progress. Yes, indeed, this trade up actually works in our favor and hit right at the S2 level. All right, so we covered this volatility breakout strategy, taking into account of what we have learned so far in module 1 to module 4, and also taking into account of the indicators that I cover in module 5.